Hello there. Welcome to lecture 11 of the day trading model. This lecture is about breakthroughs. You might be wondering, what does a breakthrough mean? A breakthrough is basically a moment in time where you experience a breakthrough in your understanding of algorithmic price delivery. During this lecture, I'm going to discuss a variety of topics that I think that might not be clear yet to you watching this lecture all the way at the lecture 11 of the series. What I will do during this lecture is the following. I will take you with me through a whole week of price delivery so that you can look over my shoulder how I navigated this week and how I internalized every single session to determine whether or not a session was higher probable, low probable, whether or not it should be skipped, or whether or not I should look for the setup to present itself, etc. I am 99.99% sure that at the end of this lecture, you will at least have learned one new thing that you did not understand yet when it comes to this series. Before we begin with this lecture, I must first give you a risk disclaimer, of course. TOTK is an exclusive educational platform, meaning all of the content that gets shared on this platform within my mentorship is purely meant for educational and or entertainment purposes only. Nothing that I will share with you is meant for financial advice, and I'm not a financial advisor. This is something you have agreed upon when signing up to the mentorship. Therefore, these documents are legally binding forever. Before you watch this lecture, there are a few things that need to be very clear to you. You need to know what the model looks like. If you do not understand what the model looks like, this lecture will do you no good because you're watching this lecture way too soon. Secondly, you need to know when the model is likely to occur. If it's not clear to you yet when the model is likely to occur, then me breaking down when I believe it is likely to occur will not do you any well, because you would just take my word for when I believe it's likely to do you well, not based on your own understanding. You need to know how one can operate in the parameters of the model, meaning you need to understand the rules and how these rules could be utilized to determine whether or not the market is likely to deliver in a certain way. If you do not understand any of these three topics mentioned prior, this lecture is not for you yet. Please go through all of the lectures prior before watching this one. The table of contents for this lecture is as follows. We're going to take a look at the weekly navigation of a CPI week. A CPI week being, of course, a high impact news driven week filled with landmines. How could one potentially go about determining when the model is likely to present itself and when one could potentially see setups occur? Avoiding low probability sessions will be a topic of discussion. And secondly, we're going to take a look at engaging high probability sessions. Let's dive straight into it. Here we are on the hourly chart of the Nasdaq. And what we can see is that we're currently on the delivery of Tuesday. Tuesday has delivered, and we're going to take a look at Monday and Tuesday. We know that at Wednesday, in the middle of the week, there was a CPI release for the dollar. What could we potentially anticipate in advance of CPI? What we can anticipate is that the markets are going to be held inside of tight ranges, because liquidity can get engineered that way that can be utilized to draw towards during the CPI release. What we can see is that on Monday there was no high impact news driver, and Monday just delivered sideways. Does this look like a day of delivery where there were any high probability setups, according to the model that I'm teaching you? No. Why not? Was there any higher time frame order flow present? Remember, we're on the hourly chart right here. Was there any order flow present on the hourly time frame that led you to believe that the market was either going to draw higher or lower? No, there wasn't, right? So when that is the case, what can we anticipate for the whole day? Consolidation, sideways delivery, seek and destroy. Compare this delivery to Tuesday's delivery. Tuesday's delivery is volatile, meaning clear swings are being made at logical levels. Whereas on Monday, the market just goes sideways, goes up, down, up, down, up, down, up, down. And as a scalper on a seconds chart, this is by no means a hard environment. However, if you're trading according to the rules that I'm providing you, on your demo account of course, this is not the environment in which you want to push it. And this is exactly the environment in which people try to push it too hard and they take unrequired losses, and that begins the week in a negative way. And what occurs then? If they begin the week in a negative way, the remainder of the week, they're constantly thinking about, I shouldn't have done that on Monday. I shouldn't have taken those trades. I shouldn't have taken those losses. They were unrequired. They were stupid losses. So they project those feelings onto the marketplace. Boom. Whole week is basically a waste of time and capital and real mental capital. Because they're trying to get back what they lost on a day that was low probability. And therefore, I'm sharing with you, this is a day that you can avoid. What are some of the specific signatures that were present, you might be wondering? Well, take a look at how the New York session right here delivered relative to London. London high, London low. Notice that the London high got taken out during the morning session and the London low as well. Of course, a trade was possible from the high to low or from the low to high. However, besides that, no opportunities. If we then zoom in on the lower time frame, we can see here I have annotated the Tuesday delivery. I'm avoiding the no news Monday within this CPI week, so I've put a red box around it. What I've done is that I've annotated the buy side liquidity of Friday and the high of Tuesday. Why? Because relatively equal highs have been created, meaning I have a clear draw on liquidity. I know that buy side liquidity is engineered above here. When I then see the morning session drop aggressively right here, and I see a failure to displace lower, but instead I see the market lethargically trade away from this imbalance right here during the afternoon session, when I see this right here occur, this slow delivery, I know that an expansion is imminent, and I know that the market is likely to draw towards all of the buy side liquidity above these highs and potentially even higher. Why? How could one know that? Well, think about it this way. If the market was going to expand lower ahead of CPI, why didn't it occur right away? Why did it take 3 candles before the market eventually reversed? Meaning first candle, second candle, third candle, fourth candle reversed and expands higher. So there were 3 candles that could have expanded lower, but it didn't. Instead, they just engineered buy side liquidity, and that is a key signature. The best trades, the best setups, they are quick, meaning you enter and the market begins to run. In this case, to determine the order flow, because I don't trade based on the ROE time frame, I look at this and I think, well, if they wanted to distribute it lower during the afternoon session, it would have already begun running lower. So when that is not the case, I know that during the final hour of the day, the market is likely to draw towards buy side liquidity in advance of CPI to engineer more liquidity on both sides of the marketplace. That's exactly what we see. During the final hour of the day, the market expands higher aggressively after trading into this rejection block where a low forms, the low of this particular candle. For the full trade breakdown, please go to the trades breakdown of this specific week. What we see is that ES did not trade into the close of this down close candle, the close to wick to be precise. This is a bullish rejection block, whilst Nasdaq did. That's a form of SMT. SMT between two PD arrays. When one highly correlated asset reaches, for example, a rejection block, but the other highly correlated market does not, that's a form of SMT that signals that the market is likely to expand now. SMT standing, of course, for smart money. But what does the T mean? It means time. It's the right time to expand now. Therefore, the moment you see this occur right here, ES not reaching its rejection block whilst Nasdaq does, as an alarm sign, as an alarm bell. Watch out, something is on the way. If we then zoom in on the lower time frames, we can see a perfect setup where we can see this very slow delivery lower, which of course engineers buys at liquidity above all highs. Take a look at the time cycles. PM cycle 1, PM cycle 2, PM cycle 3. First 2 PM cycles engineer buys at liquidity. Third PM cycle manipulates below the second PM cycle's low. Takes out all of that sell side liquidity, trades into that rejection block, boom, reverses and expands higher into a premium of the current daily range and even beyond that eventually. That showcases to us perfect AMD, where we see the market go sideways, a accumulation that isn't perfectly sideways, but instead it's lower right here, manipulation below the previous cycle low, distribution above that old accumulation phase. Beautiful market maker buy model went wrong inside of this push breaker. SMT was present right here on the lows with the door index. If we then take a look at the next day, we can see the following. We can see that on Wednesday we had that CPI release. With CPI, the market initially manipulated higher, trading into this inversion value gap right here, forming a high and then immediately distributing lower. Now my question to you is the following. After the CPI release, after such a large candle, after such a big down close candle, would you consider that a high probability trading environment? Look at how big this candle was relative to the previous range, to the size of basically all the candles prior. This one candle traded in a bigger range than all of the previous days together. Or their average, I should say. It doesn't take a genius to realize that if that occurs, that there's of course a very volatile move that has taken place. And when you know that, the delivery that's likely to follow is going to be choppy, is going to be messy. So does our model present itself in that environment? No. Why not? Because we only look for setups in the cleanest environments possible, where the delivery is smooth, where we can anticipate low resistance liquidity runs. And what we see for the remainder of the day on Wednesday is of course that the market goes sideways, consolidates, and there's literally no real high probability setup that takes place. Now notice that I don't even have to go onto an M1 chart to determine this. I'm just on an hourly chart. I can already see the candles speaking to me. I can already see them basically saying, nope, not today. Today it's not happening. Today the setup is not present. Surely there are very small scalps that are possible within these ranges. But would you rather wait for a day and wait for a clean bread and butter setup? Or would you rather go into the lower time frames on the second chart and start scalping the range and be surprised that the market just goes sideways? I think the answer is very clear to that question. What I've done here is I've annotated the whole range and the whole size of this candle. Look at that size. One candle. Insane. It takes out buy side liquidity above the previous day high, and it takes out sell side liquidity below the previous day low. There's no real higher time frame objective that the market could potentially reach into for that day yet. And therefore, this whole red box can be avoided just like Monday's delivery. When a session is deemed low probability, what does one do? Do we stare at it? Do we open our charts and keep on monitoring prices going sideways? Of course not. We do the opposite. We just close our chart, we just close shop, and we do something fun. We relax. Why? Why do we do that? Because if we don't, we're gonna take unrequired risk and unrequired losses. Whilst the person who has controlled himself and who knows the strike rate, I should say, of its or of his model, where he knows this is how many times model forms each week on average, this is how many times it wins on average, etc. You can say, I know a new setup will form. I know a new day would come around where a high probability setup will come. And that's why they don't force it in such an environment and they just do fun stuff outside of the markets. And that's exactly in that balance between being super focused on the charts and relaxing and enjoying life that success is to be found. Being too over focused on the charts will not do you well. In fact, the best performance is likely to come the moment that you start relaxing more, start trading out of basically a business mindset that is fully focused on doing the right thing consistently. And besides that, having hobbies outside of the charts that will be able to help you get to a state of mind where you're completely at peace. You're not running, you're not trying to get somewhere too soon, you just accept that your setup will form another day, but that the day it's likely not to occur. And if you feel the need to prove yourself to others, you need to say to yourself, well, wouldn't it be so commendable for me to be able to prove myself to others in a way that I can show to them that I'm consistently able to execute the same rules over and over again, instead of just showing to them, okay, look, I did something today, look, I did something today, look, I did something today. Again, the answer is pretty clear right there. It's the discipline that will eventually get you rewarded. It's the fact of consistently doing the right thing, listening to the analyst, that will get you rewarded. Here we're on the 1 minute time frame, and this is the delivery inside that red box after CPI. It doesn't take a genius to realize that this delivery is absolutely ugly and absolutely messy. If you think otherwise, then you do not understand the model that I'm teaching you yet. This is a high resistance liquidity run environment in which there are a lot of false moves before the market eventually begins to run. Again, environment selection wise, environment recognition wise, everything is screaming, get out. And with get out, I don't mean necessarily a trade. However, I mean get out of the whole session. So the day after CPI, meaning Thursday, we saw the following occur. We saw a very clean delivery day where the market did the following. First of all, the market opened up and it manipulated lower, trading into the close of the CPI candle right here to the wick. This is a rejection block, bullish rejection block. Because the market failed to displace lower with CPI's release, we knew that Nasdaq was likely to draw higher. S&T with ES relative to the CPI candle to the previous day low confirmed this. Then at 8:30 on Thursday we had high impact news as well. What's curious is that the market displaces higher and we see it displace above this high right here. The high that's set up to run lower below this short-term low right here, this sell-side liquidity. A BC gets created inside of that process of displacing higher. Now, when the outcome of CPI is negative in a way, if it gets deemed to be a bad release, what do you think the majority of people do? They of course try to go short. They want to open short positions because they believe that the market should go lower if the outcome of CPI is that bad. What we see is that the market instead runs on all of that buy side liquidity of those early shorts. This occurs during the lunch hour, or I should say the beginning of the PM session rather, because at 1 PM there was high impact news and that set up this whole leg higher. And the reason why that's significant, the understanding of that news liquidity, is the following. If the masses interpret the outcome of a specific news event as negative or positive, we know that the liquidity of the opposing side is likely being engineered right now. Meaning, if the outcome of the news was bearish and we see the market expand aggressively lower, every single retail-minded trader will look at that and they will think, you know what, let's just go short. It's so bearish. The outcome of the fundamental analysis is bearish. Technical analysis is bearish. Let's go short. We place a stop above the CPI high, and what happens? The market, of course, runs on all of that buy-side liquidity. Market retraces into that BC, and this is where a lower time frame market maker buy model occurs. Now notice the difference in size between the displacement legs relative to this candle right here and this candle. You can already see, this is me purely doing it based off my own eyes, but if I would take an estimate, I anticipate or I estimate that this candle is 1/3 to a half of this big down close candle. This candle signals and screams displacement. It screams we're gonna go higher. This candle, however, says this is manipulation. I know it may sound a bit weird. How could the candles potentially say that? It has to do with how the candles reprice and based on what they get repriced. If, for example, CPI gets utilized like it did during this week, where we simply see this big down close candle, we need to apply the logic that I just described to you, especially when we begin to see bullish order flow begin. It all begins with that SMT right here inside the potential point of interest. Market displaces high, it retraces. This is where I went wrong, targeting buy side liquidity done. More than enough. Could I have held it all the way to the CPI high? Yes, I could. Technically speaking, yes. However, due to the environment selection of the whole week, I've decided to just take scalps, be content with enough, be content with previous cycles high, and that's it. So if we zoom in on the time frame now, we're going to take a look at time more in depth. We're currently on the hourly chart, and what I've done is I've annotated every single ATM candle. I'm just going to give you a second to look at this, and I want you to just pause the video and try to interpret what I'm sharing with you visually before I start explaining myself. I know some of you never pause the lectures and you're just wasting this opportunity to learn. Don't do yourself like that. So what we can see is the following. We can see first of all that this ATM candle was right here, this big upclose candle. Then on Wednesday with the CPI release, the market repriced into that ATM candle right here and then immediately formed a high and rejected it. It traded lower. This low forms, of course, during that CPI release, meaning this is the low of that ATM candle. The next day, on Thursday, what happens is the following. Market reprices lower. At what time does it reach the close of this hourly candle? During the 8 to 9 hour. When does the low of day form? At exactly 8 to 9. What does that mean? It means that during our current time cycle, our current hourly candle, price is referring back to the previous hourly candles that are of the same time. So when we see that those candles are reacting in a certain sense to a previous candle of the same time cycle, plus we are seeing SMT, plus we are seeing whatever confirmations we want to apply, we know that a reversal or expansion is likely to occur next, where we're going to see the order flow change from bullish to bearish or from bearish to bullish, of course. This is what we call TEPTA. If we zoom in on the 1 minute chart, the breakdown has already been done inside the breakdown lecture, the same one I referred to prior. However, a rather simple breakdown is the following. Market retraces into a discount of the current dealing range from this low to high. It reprices into that discount, forms a low there, and then begins to show signs of reversing and drawing towards these relatively equal highs that are of course engineered by side equity. Hourly chart, Nasdaq again, but now for the PM session, the afternoon session. Within the mentorship, I shared a very specific message. This, of course, on the forum on Telegram. I shared with the audience on there, with the students, that I would be very careful during the PM session. And the reason why I shared this was due to the following. During the beginning of the PM session, we can see that the market expanded higher aggressively. When this is the case, and we see that the market is not rejecting of a buy side liquidity target after reaching above it, we already know that it's likely going to chop around and not deliver in a clean sense. Why? Because it's not yet the end of the week, we're in a consolidation week, and therefore any particular short idea should be neglected, because we don't know how high it's going to reprice. During the afternoon session on Thursday, I decided again to not look at the charts because it was simply not worth it in my opinion. Instead, enjoy time outside of the charts. That's why having hobbies is so important. The ability to just say, I'm going to do this, I'm going to do that, and I'm not addicted to the charts all day. That right there will help you a lot. So, whenever I see such a large expansion during the beginning of the afternoon session, and I do not see a rejection of, for example, a key high, a previous day high, I know it's likely to chop around or slowly expand higher. If we would have seen a rejection of this previous day high, then we could have anticipated the market to retrace into, for example, a discount of the current day range from the low right here to the high that would form somewhere. And that's it. That's the trade done. However, that did not occur. Therefore, the afternoon session should be avoided. I've zoomed in now onto the 1 minute time frame. And what we can see on the 1 minute time frame is that I've basically annotated the whole PM session's delivery from low to high. At what point do you say in this delivery, I have no interest anymore in shorts or in looking for the model to present itself? Because if the market is going higher like this, of course, on the 1 minute time frame, the model in terms of its respective setup does not present itself at all. You might say, well, maybe you see previous cycle high get taken out here, you see this small little leg lower, this is the model. No, it's not. No, it is absolutely not. And if you think it is, you don't understand the model yet. The model is very precise and it's very specific to when there's an execution, when there's a setup, I should say, and when there isn't. And we need to see clear displacement. We need to see speed and velocity. Is there any speed and velocity to the downside inside of this whole leg higher? There isn't. And therefore no shorts could have been taken. But I can imagine that if you're looking at this live, that you're like, at what point should I even say, I'm gonna go away now. The market is not gonna deliver, it's not gonna turn around. I'm going to give you a moment to think about this before I start pointing arrows to where this realization should have come. Please pause the video. Here we go. I have annotated 3 specific scenarios in which the realization should have come of, okay, it's likely not going to deliver lower. First of all, this delivery right here. At 1 p.m. we of course had high impact news, we had a bond auction, the market basically got sent flying. We then saw the market go sideways here, and we saw this small tiny gap get created here. However, no displacement occurred below this low that formed inside this BC. Instead, the market takes out that low, purchases it, and then reverts higher and expands to the upside. When you see this occur, does that constitute in any shape or form to an idea of, a high is forming, smart money reversal is in, we're gonna draw lower? No. It shows that order flow is bullish. The second moment where the realization could have come was the following. It was when the market spent too much time above these relatively equal highs. If it would purge these highs and form a high and then displace lower, okay, then we're talking for potential shorts. But instead, the market just goes sideways and slowly gets repriced higher. The moment that the market begins to expand higher, it's obvious, close your chart. It's not going to deliver. It's simply not going to deliver lower during the afternoon session. Then the final moment that this realization could have come was all the way up here after we've taken out the previous cycle's high, and we see this rather lethargic movement lower, where it's very slow, very choppy, and there's literally no model present at all. Why not? Is there any displacement that it forms? Is there any clear discount array that gets violated and followed by the creation of a premium array? The answer to that question is no. So you need to be able to recognize these environments live and say, well, when these are the environments that we're currently in, why would I even consider looking at the charts? Why would I even spend time looking at the charts whilst I could be doing something more productive? Whilst I could be doing with a higher ROI, a return on investment. A return on investment doesn't necessarily have to be money always. It can also be a sense of gratitude or a sense of relaxation that will allow you to make more money down the line when the opportunities are right. And you need to be able to give yourself that permission. And these are breakthroughs. When you start realizing everything that I discussed during this lecture and you start putting it together, I have literally told you within this lecture, and it probably went over your head if you just watched through it without taking any notes and pausing it. I've literally told you when it's likely to occur and when it's not likely to occur. Yep. And for the people that are paying attention and they're looking at the price axis inside of this example, why is this reaction right here so important? Why is it so important that there's no displacement lag at all forming? Because we're at 18,500, equilibrium of the range. This price level has been on a chart within our reviews for this current period for a very long time. If you understand the advanced ranges, you know that this is equilibrium of a large range, and when you see the market not displace lower after trading into that level, you can anticipate it to go sideways and to consolidate, and that's exactly what you see all the way basically throughout the third PM cycle. Market expands, doesn't reverse, it instead consolidates. The next delivery that we're going to take a look at is the following. This is the ES delivery on Friday. What we can see that occurred on Thursday is the following. ES failed to create a higher high relative to the CPI high, whilst Nasdaq of course created a higher high. This is a form of SMT. Secondly, we can note that ES has been making lower lows, whilst Nasdaq did not yet. Meaning, for shorts, we are better off inside of ES than inside of Nasdaq. Because the problem we have when we're trying to short Nasdaq is that intermarket relationship is signaling to us that ES is the weak market because it's making these lower highs, it's making these lower lows, and it's drawn to a very specific price level that we've been discussing within our reviews. All we have to wait for when it comes to determining the drawn liquidity is the retracement into a premium array that we can utilize as a smart money reversal POI where we can sell short of. And what we can see is the following. We have this BC on the left side of the chart, got displaced below. This BC should now function as resistance on price, as an inversion of value gap to send price lower. Immediate rebalance takes place, of course, here, which confirms that speed and velocity to the downside is on the way. If we zoom in onto the lower time frames, we can see that one-sided institutional order flow was present. Why was this present? You might be wondering, how could we see that? What I've annotated here is every single previous cycle's lows candle, meaning every single candle that formed the previous cycle's low has been annotated. To determine and to gauge order flow, you have been introduced to the concept of utilizing time cycles, their respective highs and lows, to determine whether or not we're bullish or bearish. This is something that should be clear to you now in lecture 11 of the model series. If you understand this and you see that every single displacement leg lower is followed by a retracement into that previous cycle's low candle that's annotated with a red box, and you see that the market respects those levels perfectly and track the market maker sell model signs are present, such as market reversing at exactly or during exactly our 30-minute time of interest, SMT taking place with a highly correlated asset or market, I should say, of course, with the Nasdaq here, and the market then distributes lower, trading below this big down close candle, again functioning as resistance on price. Next big down close candle, or next previous cycle low right here, functioning as a resistance on price, all the way until that very specific price level our strong liquidity got reached. This is what real one-sided order flow looks like. This is what high probability short-term scalping looks like, where the market is drawn to a very specific price level and every single array, or basically time-based array I should say, is functioning as resistance from price. When that is the case, these beautiful runs can take place. Our job is to identify when the markets are likely to expand, and we can basically utilize our skills and knowledge inside of those environments on our demo accounts, of course. Not giving you any financial advice, not telling you to go out there and trade with real money. I'm just sharing with you what one could do with this knowledge. With that, this lecture comes to an end. I hope that you found it insightful. I hope that you had at least one breakthrough. I'm sure there was something within all of my rumble that has been considered as valuable by you. I hope that you took proper notes. And I look forward to speaking with you within lecture 12 of the model series. Lecture 12 is going to be about a very interesting topic, and it's going to be about how we can basically, first of all, manage our trades, but also manage our psychology whilst being inside of trades. I look forward to speaking with you in the next lecture.